Hi, I'm Michael Newrock, and welcome to the FX Files. In this video, I'll be going over some tips and truisms of trading Forex that will hopefully make you a better trader. Now, in the last couple of sessions, we've covered the trend catcher trading strategy, the price flip trading strategy, and the macro levels trading strategy. So hopefully you've gained at least a couple of things by now that are going to help you positively moving forward as a trader. If you have, or if you have any questions or any feedback, then feel free to leave a comment below this video. I appreciate it. And of course, you go into the running to win a 24-month premium membership that we are giving away every month. Alrighty, so let's get on with this video. To start off with, have a business plan. Treat your trading as a business. Write it down and print it out. Have it available for reference and stick to the plan. So, as I shared before, trading is a business and it's vitally important to remember that. It's not a recreational activity, it's not gambling, it is a business. So, at the end of the day, plan your work and work your plan. Set achievable goals. Base your goals on your capital. There's no point having a goal of making $1 million when you only have $500 in your account. So base your goals as a percentage of your capital and always remember that small monthly returns have significant effects on capital growth. And of course, be realistic. You will get there as long as you're moving in the right direction. That's been a good trading day or a good trading week or a good trading month. So be realistic with your goals and set incremental small goals towards achieving that bigger, grander goal. Manage your risk. Set risk per trade as a small percentage of your account. Use risk parameters as outlined in your business plan. In other words, I am never going to trade or risk more than 1% of my account or 2% of my account or whatever it happens to be. And limit the risk per trade to your comfort level. So you want your winnings to be meaningful, but at the same time, you want your losing trades to be within your comfort level. In other words, limit your total risk exposure to your tolerance level. If you're going to open up additional trades to the trade that you already have running, then make sure that it is in total within your tolerance level. Of course, the best way to add trades to your existing trades is when your existing trades are already in profit and have profits locked in. Don't trade under the influence, okay, of any substance, whether it's wine, beer, uh, name your poison, whatever it happens to be, don't do it. So don't drink and trade. Don't trade if you are taking anything that can affect your judgment or ability to trade rationally. All right, I understand you come home from work or whatever it happens to be and you want to get into trading, you have a glass of wine, and suddenly you feel a little bit more gung ho. Um, that's not necessarily where you want to be. You want to be thinking rationally and you don't want to have your judgment impaired because you are trading with your own money at the end of the day. So it is dead serious. Don't trade with your pride. So don't trade when your pride or ego are making you break your own trading rules. So if you go into a trade and you lose it and you really think that you are right and you get back in, don't do it. Don't trade with your pride or ego. So don't let your pride wreck your account. At the end of the day, leave your ego at the door. When you go to your trading desk, leave your ego at the door. Decide positions in advance. Okay, decide your position in advance of what you're going to do. Are you going to buy or sell? Don't make it spontaneous. Or if you see a candle moving up suddenly and you think, well, I'm going to get into that buy, and then suddenly it retraces and it goes the other way, especially when you're already thinking, well, with that pair, I was going to sell it. Okay, because this type of thing happens all the time. Um, in a way, the Forex markets is like a giant game of three-card Monte. They do it deliberately, or the market is going to lead you astray more than once. It's just part of the natural state of the market. Prepare your chart setups in advance. So you want to be in a position for a trade. You can see a setup forming, whether it's a trend catcher trade or a price look trade, macro levels trade, or whatever the trading strategy that you're using. Place your entry level of roughly where you think you're going to get into the market, your stop loss based on resistance levels or support levels or whatever they happen to be, whether you're buying or selling, and your targets based on recent levels and macro levels of where you want to take your money. Okay, so when the trade setup does occur, if it does occur, you're all set up in advance and it's not going to be rushed, and you're going in there with a level head, with a clear um, understanding and intent of what you want to do. Select the time frame you're using for the trade and stick to it. So if it's a 4-hour time frame, then don't change it. Okay, or if it's a 1-hour time frame, don't change it. Stick to the time frame that you're using. And don't change your position once the trade is active. Don't be greedy. Your goal is to have financial success over the long term, not all in just one trade. Take your profits when the price hits your targets, okay? Or at least lock in your profits at those target points. Capital grows through small winners, not just the big winners, and that's an important point to note. If you're consistent and you're getting small winners on a regular basis and they're outweighing the losers that you're having, then you're moving forward and your capital will grow. Keep a trading journal, log all your trades, go over the details of the winning setups and see why they were winners. What was it about those particular trades that made it a winner? Go over the details of the losing setups, and same applies. Work out why those trades were losers. The answers to your successes and failures are in the details of your own trades. Maybe you had a couple of drinks that night. Maybe you were going to sell, but you ended up buying because something happened. Maybe you weren't prepared. Whatever it happens to be, if you write it down, it's going to ultimately make you a better trader. Balance opportunity and failure. So make sure you always have at least a 1-to-1 win-loss trade ratio. And be aware of the risks existing in every trade. Don't cut your profits short unnecessarily, and I'm a big advocate for that. It's always good to let your profits run. When you're on a winning trade, it's great to let them run because, quite often they continue to go much more than you expected. And, you might then have a series of 2, 3, 5, 7, 10 losers in a row. So when you are on a winner, you want to make the most of that winning trade. And don't let your losses get out of control. Losing trades is like a bad relationship. You want to cut it off, early and quickly. I don't know how politically correct that is, but hopefully you get the idea. Don't let your losses get out of control, and don't give them the benefit of the doubt, hoping that things will get better. Okay, cut them short. So learn from your mistakes. Know what your strengths are. Know what your weaknesses are. Double check your trades before, during, and after the trade. And be willing to change. It's the one constant in life is change, and the same applies with trading. Be willing to make changes to improve yourself as a successful and consistently successful trader. Control your emotions. Learn to deal with the emotions of winning and losing, and accept that losses can and do happen. Again, it's just part of life, it's just part of the game, it's just part of the business. And in that light, think of your losses as overheads of your trading business. So learn to manage consecutive losing trades because there will be times where you get a consecutive number of losing trades. Okay, it happens. Um, it's important to be able to control your emotions when those times happen. It's easy to ride the highs. It's much harder, challenging to ride the lows, and it's important to be able to control your emotions during those times. So don't become an overconfident trader. That's the other flip side of the coin. If you get 5, 7, 8 consecutive winners, and then suddenly you up your lot sizes and take more risks because you're indestructible, and then suddenly bang, you just have a big loser, and you lose all the profits of all those consecutive winners by being overconfident. Stick with one strategy. Okay, pick your strategy and stick with it. Or if you're using multiple strategies, like for example, trend catcher, price flip, and macro levels, make sure that they're in harmony with each other. Learn the strategy so it is second nature. Practice identifying trade setups of that particular strategy that you're using, okay? Because in every strategy, there are good setups and not so good setups. And I've gone over that in particularly in both trend catcher and price flip. There are good strategy setups and bad setups, and no matter what trading strategy you use. Examine the trade losers to learn why, and examine the trade winners to learn why. And then eventually, over time, you will learn to pick winners a lot better. So, your winners will outweigh your losing trades. Don't overtrade. Do not overtrade, whatever the reason. Okay. Do not trade when you are tired. It's not a good thing. Do not trade when feeling negative. Whatever it is in life, it's good to maintain a positive attitude. And with trading, if you're in a negative space, then I strongly suggest you stay away from your trading desk until you're feeling better. And do not trade when pressured for a positive result. For example, if you've had a couple of losing trades and you want to end the day or end the week on a positive, so you get one last trade in or whatever it happens to be, that's not the way to go about um, coming out on top in the long run. You might have a winner, but if you have a loser, it's just going to be even worse. So don't overtrade. Know what support is. Okay, so know what your support levels are. It is vitally important, as I shared with you in macro levels. Incredibly important to know what your support levels are and know how support is identified. Know where your support exists and learn methods that indicate support. Of course, for the macro levels, it makes it a lot easier because you get the data feed with the macro levels for the term of your membership. So you'll always be able to uh, be confident of knowing where your support levels and stick to those support levels as buy zones. So highlight the support levels on your chart so they're identified and you don't forget about them. Okay, and that way you won't fall into a case where suddenly prices, moved in the opposite direction and you don't know why. It's because there was a support level there. And the same applies with resistance. Know what resistance is. Know what your resistance levels are. Know how resistance is identified. Know where your resistance exists. And learn methods that indicate resistance. Again, with the macro levels, indicator, you get the data feed to be able to provide you with all of your macro levels, both primary and secondary. And it has the flexibility of being able to add in other temporary levels that you wish to include as part of your trading. And highlight resistance levels on your chart. Price goes up. The price goes up when there are more buyers than sellers. Sometimes the price can spike or rally quicker than expected. Sometimes the higher price is shortly lived. Price goes down. The price goes down when there are more sellers than buyers. It sounds obvious, but that's just the way the market works. Sometimes the price can drop quicker and further than expected. Okay, so don't rush into a buy if the price is going down. You want to look for, those support levels, for example, or a new trend forming, like with trend catcher, or a reversal pattern, like with price flip. And make sure that you don't take necessarily the first setup that occurs because price could continue to fall further, particularly down to a lower support level. So sometimes the lower price is shortly lived. And don't panic. Whatever you do, don't panic. If you're in a bad position or trade due to a mistake or market event, don't panic. It's going to happen. When those cases come up, it's important to keep a level head. Stick to your trading rules no matter what is happening, and things you don't expect can happen. It's just always that way. So, in other words, be prepared for the unexpected. Know your exit strategy. So, first of all, have an exit strategy. Know when you're going to get out of the market. Know when you're going to take your profits. Know when you're going to lock in your profits. And know when you're going to exit the trade totally. So, know when to take your profits. Know when to take partial profits. Know when to take profits early. Okay, if the trade isn't performing as well as you expected and it's showing some contrary signals, maybe the MACD has changed, maybe a price reversal has occurred from your price flip indicator, maybe it's hitting a macro level and it's just not going higher or not going lower. You thought you might be able to to take that trade successfully, and maybe you have, but maybe you're only 10, 15, 20 pips up, and then it's hit this particular level, and it's looking like going the other way. So in those cases, either lock in your profits or bring your stops to break even or take the profits early. Know why and when to exit a trade early, for the reasons that I've just mentioned. And as you trade more and more, you'll learn to recognize these events in trading. And grow your capital as well as your equity. So it's great to have a high equity in your trades, in your existing trades that are live, but it's also important to lock on those profits and to take the profits when they're there to grow your capital as well as your equity. Don't be reckless. Don't trade freestyle. Have a deliberate intent in mind when you take a trade and before you take a trade. Okay, you want to have everything all set out before you take the trade, where you're going to get in, where you're going to get out. Don't trade without your trading plan. Don't trade beyond safe leverage levels. And don't trade without the criteria of your setup being fully satisfied. Okay, because otherwise you're just going on gut and gut instinct that may turn out okay, but if it doesn't, then you've got no one to blame but yourself because the trade setup wasn't fully satisfied. And at the end of the day, a small profit is much better than a large loss. So as much as you would have liked the price to continue in your intended direction, if it's not to be, it's not to be. So better to take a small profit than a large loss. Keep weekend exposure low. If you have trades open over the weekend, tighten your stops, or if you're concerned about it, close the trade out totally, because there are big gaps that can occur on market open after the weekend. Be aware that gaps on market open can wipe out your trades. Okay, they can go from profitable to you know a total losing trade, being wiped out because of that gap. Now, it doesn't happen all the time, and on most weekends you won't get too much of a gap, but there are weekends where something happens over the weekend and the market reacts um, with a high degree of volatility. So on that market open, bang, you're out of the game. It could work in your favor as well, but you're taking a risk when you leave your trades open over the weekend. So be aware that start of the week trading can be volatile to flush out positions. Okay, so not only the gap, the weekend gap is something to be concerned about, but also that beginning of the week trading. Balancing risks and rewards, ensure at least a 1-to-1 win-loss ratio, and enter into a trade accepting a potential loss and adjust your risk to your tolerance. So if you adjust the pips of stop loss, adjust your lot size to control the total risk. So if you increase the pips used on your stop loss, reduce the lot size. Um, On the other hand, if you reduce the number of pips in your stop loss, you have the opportunity to increase the lot size without increasing the risk. So it's always that balance. Never add to losing positions. Don't try to average out of a trade by entering new trades. Okay, so if you're down um, in profit on the trade, then that's not a good time to add positions to that trade. Don't add new positions to your losing position is the bottom line. And minimize your losses by letting it stop or exit early if conditions have changed. Okay, once again, better to get out early than to stay in a bad trade. Don't love your positions. Even if your trade is profitable, do not fall in love with your position. You know, the dark side could come at any time and, all hell could break loose. So you never want to be too stubborn and too in love with your positions because change is a natural state of being in the markets. And sometimes it can happen very, very quickly. Hence, lock in your profits whenever you can. Be flexible with your open trades. Be open to the possibility of direction changing. Okay, so you can stay out of the market if it changes, take your profits and wait for another setup, or gauge it based on, if it's a new trend and a strong trend forming on a new crossover, or it's a strong price reversal, price flip that setup that's occurred, or you've just hit a macro level and it looks like it's going the other way, then you can get into the trade on the other direction. So don't be in love with keep continuing to buy into that particular pair or sell, whatever it happens to be. Be open to change. Or set it out and wait for a new setup to occur if you think that it is going to continue in your intended direction. But you can always get back in on a new trade. Good trades are like buses. There's always another one around the corner. So don't insist you are right just to justify holding losing positions. Don't keep losing positions. Cut your losses short. Now, I've already gone over this a little bit in this video, but I can't stress that enough. Cut your losses short when things are not looking good. Holding losing positions is psychologically bad at the very least. It's not good for your account either. So don't think that hoping for a reversal is going to help your position. The longer the position is held, the less likely the original signal is still valid. Okay, that makes sense. Um, In fact, in most cases, it'll be void once that position is in a losing state. Many moves are meaningless, and that's something to be aware of. That doesn't necessarily mean anything, or it could be totally intended to catch people off guard and to, on a spontaneous trade, to go in the wrong direction. Okay, so but in many cases, those trades are meaningless. There could be profit taking occurring. It could be a small news event that's just come out, or it could just be something in the market that has no meaning whatsoever. But if you're in a trade and you've got your profits locked in, then you can ride it out. If it takes you out, it takes you out for profits. But if it resumes its intended position, then great. But don't get too caught up on every single bar or candle that you're trading. And sometimes it's better than less is more, and to manage your trade um, in an intelligent manner, but not to overmanage your trade. So many moves are very short term for that very nature, and they can resume in that original direction. Many moves are overreactions to news events. Many moves are deliberate to create better buying opportunities or selling opportunities. The trend is your friend. Okay, the trend is your friend until the end, and I went over that in Trend Catcher, and that's exactly the way that you should look at it. Don't fall in love with that trend and your position. Just remain in that position while the trend is trending. So once the trend has ended, be accepting of no trade consolidation periods before trading again, okay? Because that will sometimes happen. You'll go through a consolidation period, a bit of a meandering, a bit of an up and down, and then the um, the pair will find its true direction once again. Wait for the restart of the trend or for a reversal sign of a new trend. Okay, or if you're strictly in price action, then look for those reversal patterns or those support or resistance levels that provide you that indication that a new direction has been entered into. Know your trading sessions. Know the main trading sessions, what they are and how they may affect your positions. Okay, because it's a 24-hour world, a 24-hour market, and as we go from one session, from the Asian session to the European session, from the European session into the American session, we're getting a crossover of sessions. So you'll have traders closing out as they come into new sessions, and you'll get a lot of volatility during those sessions, which can often be a good time to enter trades during those times. So enter and exit trades relative to the main trading sessions. Always good. Not absolutely necessary. And sometimes trade entries occur during right in the middle of a trading session. Um, but be aware of those session changes and be aware of volatility during the market session crossovers. Trading is not gambling. Do not gamble with your trading. Gambling is betting. Trading is a business, as I pointed out earlier in this video. So trade to win and only trade when all trade criteria is correct. If it's not, then stay out of the trade. Better to play it safe than to gamble the trade. And only focus on high probability trade opportunities. In other words, don't get into every trade setup. Try to get into high probability trade opportunities, particularly when they're at those buy zones or sell zones, as with the macro levels system. Don't revenge trade. Don't trade with revenge as your motivation. You can't get it back. Okay, a losing trade is a losing trade, and it's not good to get straight back into the market just for the purposes of revenge without any new trade setup forming. The market is always right at the end of the day. So the best thing you can do is wait for the next good trade setup and don't rush your next trade. Don't take bad trades. Okay, don't trade every trade setup. Eliminate trades that do not fulfill all your criteria and only focus on good trade setups. If you do that, you will see improvements in the bottom line and your results as a trader. Avoid low probability trade setups. They may occur. They may go well, but it is risky. So my suggestion is to avoid low probability trade setups. And don't rush trades. There are always new trades around the corner. Keep it super simple. Always kiss trade. Okay, keep it super simple. Trading isn't hard if you follow the rules and if you look for high probability trades. Don't complicate your trading system. Some trading systems are overly complicated. Your trading system doesn't have to look like a Ferrari on your charts. If you've watched the earlier videos, you can see that my trading systems are very simple, but quite often simple is best. So don't use too many indicators. They can really have an adverse effect in confusing your mind on direction of a particular pair. Don't juggle between too many time frames. That is going to be another thing that can confuse the heck out of any trader out of there uh, that trades. It says stick to your strategy, as I mentioned before. Price moves to the middle. If price is at extremes, it will typically move back to the middle of its trading zone. Okay, so don't go into a trade out of fear that you might miss the boat. Um, Wait for a retracement, and there's always another opportunity to get into the trade. The price will always move in cycles, so don't rush to catch price moves. Wait for high return opportunities. That's always the best way to trade. Research your market, gather data on the market you are trading. Be aware of market news or events that can have unexpected consequences to your currency pairs. The main ones are when central banks are looking are making an announcement on their interest rates. That's the biggie. The other one is jobs figures. So, those two are the main ones. There are other factors and news events, but you can really lose yourself in the news because there are news events all the time. So just stick to the main ones, and don't enter trades just prior to those events occurring because quite often, they can have unexpected consequences. So log all your trades, be confident, know your business trading plan, as I mentioned before, know your strategy, know your indicators, know your software, know your market, be confident when entering trades. Okay, if you're not confident, don't enter the trade. At the end of the day, trading is not a get rich quick scheme. Slow and steady wins the race. Okay, just like the old story about the tortoise and the hare. Slow and steady wins the race. Never trade more than a set percentage of your account. Don't force winners. Don't over leverage. Trade rationally. Think about what you're doing and why. Don't just get into the trade just for the purpose that you want to have a trade open. Sometimes, you might get days at a time where the trades just really aren't there. So better to not get into it, particularly on consolidation periods. Don't get angry with the market, okay? Don't let desire for big trades cloud your judgment, and never underestimate the potential of a move against you. Okay, so don't, for example, put in a huge stop loss because you think, well, I'll be safe there and I know it's going to go up. But what if the market moves against you a lot more than expected? Because it often does. You might think there's no way the price is going to get to that level, but you know, there you go. Then you've got another hard luck story when it does happen. Don't chase money. Don't chase trades. Okay, let the trades come to you. Don't chase profits. Don't try to pick bottoms and don't try to pick tops. Of course, unless you are using a good price reversal system in combination with support and resistance levels, that are of key significance. Don't guess why a move is occurring and don't insist on your profit target needing to be hit. And this is a big one. Um, let's say your target is 50 pips away and you're 45 pips up and it's slowing down, and you're just going to hold out for it to hit that magic 50 pips because you want to tell your friends or loved ones or whoever it is that you made this many pips. um, I've I've seen many times trades come within less than a pip of your target and then reverse. And I'm not talking about just retracing a little bit. I'm talking about going back to your entry level and even worse, going back and hitting your stop loss and taking you out for a big fat loss. I mean, that's a horrible feeling and you'll feel like a dill because you were just within a couple of pips of your target being hit. So again, I guess it's about leaving your ego at the door. So what if it's 5 pips away? At least lock in profit. So if it does go against you, you're going to take the money. Okay. Um, and at the end of the day, it really is not going to matter. A win's a win, whether it was 45 pips or 50 pips. You're never going to remember that in the future. But what you will see is at least your account growing in capital and not just draining away because your ego got the better of you. Learn to be patient. Don't be impatient. Trading is really a Well, it's all about patience. You need to have patience to be able to be a good trader because you can't rush the market. And if it's just not right, if it's just not at your buy zone or your sell zone, then wait. Don't be in a rush to lose money, in other words, and don't be in a rush to execute new trades. Wait for the bar close or candle close before entering trades. As I've mentioned before, close is king. In business, cash is king, or in publishing, content is king. In trading, close is king. Don't guess where the bar will close because there might be only a minute to go on that 1 hour bar, but anything can happen. A minute is a long time in trading. 10 seconds is a long time in trading. Don't overwatch trades. Once again, sometimes it's better to let your trades manage themselves. Of course, you want to lock in your profits and supervise the trades from time to time, but don't overwatch them because you'll be tempted to adjust your stops too tightly or whatever it happens to be, and then you'll get knocked out even if it is for profit, and then watch the trade continue to go, or the pair to continue go in your intended direction another 200 pips. Had you not overwatched it, then you would have been in a much better position, both in equity and in capital. Don't second guess every move of the trade. Don't focus on the price until the bar closes. And as I mentioned before, close is king. So know your trading platform. Know how to add and modify stops second nature, so you're not mucking around with it when you're trying to get in the trade really quickly. Know how to add and modify targets, and know all the main shortcuts of the trading platform. Again, just to make things easier for you, um, so at least you don't have to worry about that side of trading. Don't lie to yourself. Learn from your experiences, learn from your successes, learn from your failures, and look at the result of every trade with eyes wide open. And if you do that, I'm sure that you will move forward positively as a trader. So at the end of the day, be truthful to yourself. Focus on your trades. Focus 100% on your trading. It's no good getting in a trade when you are not focused. So focus on your entry, focus on your exit, focus on the trade scenarios and what actions you need to take for each scenario, and focus on your daily, weekly, and monthly trade results so you're always moving um, in the right direction. Understand volatility. Pay attention to the market data and what drives volatility. Understand that what goes up can go down, and understand that what goes down can go up. So be aware of moves from the day's press releases and events. Okay, but don't get too caught up in it. Personally, I'm a technical trader. I do look out for the important headline figures and for the main events, which are, as I mentioned before, interest rates and job figures. You do get production data out as well, but the main ones are interest rates and jobs. Don't take it personally. Don't take trading personally. If you can't let go of a negative experience, take time off before trading again. Trust me, there is no conspiracy against you. Okay, I hear quite often traders will say all kinds of weird things, um, but have a decent broker with a no dealing desk. That's a good start, and be assured that there is no conspiracy against you. However, always be looking out that the market is full of deceit, um, and it's important to know the beast that the market is and understand that trickery is part of the game, but there's nothing personal against you. So don't trade if you can't trade objectively. Have a limit. Limit how many trades you take in one day. Limit your losses per day before trading again. So if you've reached your limit, that's it. You've reached your limit and stop for the day. Make a rule of how long you need to wait before trading again after hitting your limit. You may not want to get back into the market, back into trading again for a day or for a week, whatever it happens to be. It's always good to, decompress, take some time, and then come back to it fresh. So have a weekly loss limit so you don't continue to trade that week. A zero-sum game. Trading is a zero-sum game. Okay, there can only be one. There's no partial winner. It's either you win or you lose. Of course, if you're locking profits, then you're going to alleviate that. But understand that the price is either going up or going down. You're either right or wrong. So for every winner, there is a loser. That's just the nature of trading, and that's how the market works. Only one position is the winning position for the current session, and you are either going to be on the winning side or the losing side. Stick to your rules. Keep a rule book for your trading rules. Keep archives of your trading rules so you can refer to them. Include amendments in your rule book and review your rule book regularly and base amendments on your results. Again, all of these things will help you become a better trader. Educate yourself, always be open to new concepts, invest in yourself with continuing education. I'm a big advocate for education. It is the thing that equalizes the playing field. Visit forums which have traders with like-minded goals. Be a trading geek and learn as much as you can. And that makes sense. Whatever you're into in life, it's good to educate yourself and always be looking at improving yourself. Don't demo trade forever. At the end of the day, one day you've got to trade for real. Consider trading with real money when you are confident with your demo trading. So certainly demo trade, but don't do it forever. Otherwise, it becomes well, you've got to get into the real world sometime. You will know when that time is. And adjust the trading lots traded to suit your real money account. Be consistent. Keep every part of your trading consistent. Keep your stop losses consistent, keep your take profits consistent, keep your trading lots consistent, and keep your trading strategy consistent, most importantly. Attitude is everything. Only trade when you have a good attitude. So focus on your positive personal relationships, check your emotional state before you trade, and keep a winner's attitude regardless of having a winning or losing day. And of course, maintain your health. Health is vitally important. Without health, everything else doesn't really mean much. So, you know, it's important to look after yourself and keep a positive attitude. Determine your success. Decide what it will take to achieve success for you. Determine what you need to do to remain successful. And quantify success for your own trading life based on the time and the capital you can devote to your trading. So that wraps up this video. Of course, I'd love to see you as a new member of Traders Elite. Um, we provide signals by email, by mobile notification, and of course, as a premium member, you'll get all of our indicators as a bonus for joining right now as part of our 4th year celebrations. So with 12 months free and the bonus indicators, I'm sure you'll have more than enough signals to keep you occupied. In fact, typically around 50 signals a week if you are using your indicators correctly. We don't send out nearly as much as that, just a fraction of that. But with your indicators, then you'd certainly be able to trade whenever the time suits and whenever you're in a good position to trade. Um, so I look forward to seeing you as our new member. Once again, if you do have a question, comment, or feedback, feel free to write it below in this video. Until next time, good trading, live well, and I'll see you soon.